Thank you all for joining. My name's Jay Balekar. I'm one of the partners, principals here at Prosper Capital. Started working with Andy and DJ at Prosper about a year and a half ago now, officially. But we've been doing deals for about 3 years together. But individually, we've done deals in the past, and we've been real estate investors for over 6 years. And we all primarily focus on multifamily real estate. So the main goal for this webinar was actually to give everyone a sneak peek, especially our investors, co-GPs, as to how we are approaching the market cycle, how we are defining our investing strategy, given the amount of volatility that we are seeing in the market today. So with that, I'll pass it over to Andy for a quick intro.
Yeah, Jay, thanks a lot. And welcome, everybody. Appreciate everybody spending their time tonight with us. I'm Andy Crawford. I've been with Prosper since 2020. I've been an investor since early 2019. Jay's put up with us for the last year and a half or so, so I think he's going to stick around. So he's been a great addition to the team. And like Jay said, our primary focus is, an asset class, which is multifamily. And we've done really well over the last couple years, continuing to build our operations team and had a very successful year last year with acquisitions. And it's exciting to share some of our market insights with you tonight. So thanks for being here.
Awesome. Thank you, Andy. I'll go ahead and start sharing my screen, and we can get the party started. All right. So as I briefly alluded to, the main reason for this call is to provide an update to our friends, investors, co-GPs, perhaps even other multifamily operators. Would love to hear feedback from folks here who are joining us tonight. I do know that a lot of you are also multifamily investors, either passively or actively investing in this asset class. So there have been definitely a lot of changes in multifamily and broader, just speaking about real estate in general in the last 3 years or so. So it was a bull run going from 2010 through 2022, and things have definitely changed now, and the growth has slowed down. There's a lot more uncertainty. There's a lot more fear in the market. In Midwest and Cincinnati, we are still not seeing blood on the streets. Usually people say you got to wait to buy until you see blood on the streets, but in some cases, I think we think differently. I think any time is the right time to buy. You just have to keep defining the strategy based on the market conditions that you're seeing. So that's kind of what we plan on covering on this webinar today. We would like to stay at about 45 minutes, that we will leave 10 to 15 minutes towards the end for really an open conversation, any questions, so that we make this a little bit more interactive. In the meantime, if there are any questions that come up or any comments that you would like to make, you can use the chat box here, and I'll try to keep an eye out on that as well. So the agenda today is primarily to first talk about our goals, essentially from an investing standpoint. What are our top goals? Then we look at overview of the shifting market conditions. Now, a lot of you are active investors and are constantly looking at the market, so some of this might be repetitive, but based on the shifting market conditions, how are we looking at our multifamily deals, and what are the types of assets that we are now going after, and what are the types of assets we are not going after, which we used to in the past, given the market has shifted. So that's going to essentially trickle into our deal buy box. I'll make some commentary around kind of the overall underwriting assumptions that we are making based on kind of the shifting market conditions. And then finally, what does this all mean for you as an investor or as a co-GP or as another active multifamily investor? So our top goals always primarily is to protect investor capital. Investor capital is sacred. There's a lot of trust that investors put in us when they invest in our deals, and protecting that investor capital is first and foremost the most important goal that we have. A lot of people have lost investor capital lately, especially in the last 3 years, and that's also primarily because the market conditions have shifted significantly. But also, I think there was a lot of reckless behavior in general in the syndication space, specifically multifamily. It was an overheated asset class. Just about anyone would become a multifamily syndicator in a year or two and raise millions of dollars, but they didn't really understand how to operate the deals, which is also kind of why we have always subscribed to the idea that we got to start small with our own capital, make smaller mistakes, learn from those mistakes, and then try to scale up and start taking investor capital, which is what we have done in the past 6 years. So we take investor capital really seriously, and that's our number one goal. Point number two is to maximize risk-adjusted returns for our investors. And a lot of times, when we look at multifamily deals being marketed, you're only looking at overall returns. And in the past few years, people have invested just based on the face value of these numbers being marketed. What's the cash on cash return? What's the IRR? And that was the only way of comparing deals rather than the track record of the sponsor, the asset location, the asset type. People were really discounting the risks. They were only looking at the upside or the returns and making investment choices based on that. And one of our goals from this webinar is also to kind of educate some of the investors that we really need to start looking at returns from a risk-adjusted returns standpoint. That way we are actually truly understanding the risks that we are taking to achieve those returns. Third is provide exceptional service to our residents. My partner DJ is not on the call, but he runs our operational side of things, the property management business, the service line of business. And time and time again, the one goal that's drilled into all of our employees and contractors is we want to be the number one property management company in the area. And that's because by the end of the day, the residents are the ones who pay us the rents. They pay our bills. They keep the properties afloat, and they protect investor capital, which is why keeping residents happy is extremely important. And it's not enough just to provide a good product or a good renovated apartment for the resident to live in, but also to provide exceptional service, because that's what keeps the residents continuing to come back to our properties, renewing leases at our properties, and also talking to their friends and families to rent with us. Fourth is invest for the long-term growth and appreciation rather than short-term gains. Almost all of our deals, we have barely sold any of the assets that we have owned. The only stuff that we have sold is probably something like smaller properties that were taking up too much of our time. But we believe in long-term growth and appreciation, because every time you sell an asset, you're breaking that compounding cycle and your money is not compounding anymore. So we believe in buying good assets in nicer areas and then continuing to hold them long-term. And essentially that is going to continue to be our strategy rather than looking at Class C assets in C neighborhoods or below, Class D neighborhoods and so on. And then finally, of course, everyone wants to scale. We have seen that in the past few years, few people have scaled really quickly, and now they are nowhere to be found. Multiple capital calls, and some are out of business, some are absconding and have left the country and have found themselves in deep water. Our goal is to scale, but scale slowly, thoughtfully, methodically, and conservatively. That way, all the assets that we have in the portfolio are actually performing assets. They are cash flowing. Hopefully, we have no capital calls, because when you have that kind of a portfolio, you can keep tacking on more better quality assets to that portfolio and continue to do well, rather than driving all your energy and efforts on one or two assets that are struggling, and now that's taking a toll on the entire portfolio. Andy, anything else you'd like to add? Okay, I'll move on to the next slide. So here's some commentary on the changing market conditions, and I have a few more slides that kind of show the data. Hoping not to bore you all with a lot of charts and data. This alone can be a 2-hour webinar in terms of what we are seeing in the marketplace. Again, if you're an active investor, these are few things that you have already observed and you already know. But this definitely has to be taken into consideration when you're looking for new deals in the marketplace today. First and foremost, rent has stabilized. It has flatlined in multiple markets. It is negative in some markets, which were once hot, and that's primarily because of oversupply. Of course, it's not permanent. As that oversupply starts to get absorbed, things will improve in those markets as well. But what we are seeing is typically in the Midwestern markets, Cincinnati, Columbus, Ohio, Lexington, Louisville, Kansas City, we are still seeing positive rent growth, but it's not where it used to be. About 2022, 2023, we were seeing 8 to 14% rent growth, even in our Midwestern markets, 20+% rent growth in Sunbelt markets. Now we are seeing about 2 to 4% rent growth. So it has come down significantly. And in some neighborhoods, even in Cincinnati, Columbus, Lexington, we are basically seeing no rent growth or like 0.5 to 1% rent growth. So now most of our returns are coming from rent growth and NOI growth. So we have to keep this into consideration when we are looking at deals now. The ROI on renovations has reduced as well because your taxes, insurance, mortgage or interest rates have gone up. So your holding costs have gone up. So if you're buying a property that's half vacant, you still have to pay for electric bills, water bills, interest payments, taxes and insurance on those 50% of the vacant units. So those holding costs are now significantly higher. At the same time, the material costs continue to stay high. They came down a little bit post-COVID, but now because of the whole impact of tariffs, materials prices are going up again. So now you have downward pressure on the rents and upward pressure on materials cost and construction costs. And that's actually reducing the return on investment on heavy renovations. At the same time, the cap rates have decompressed or expanded. And as a result, the amount of equity growth from the NOI growth that you would receive through operational efficiencies or renovations has really decreased. So that's another aspect why you have to be very mindful when it comes to spending renovation dollars. So if we are able to find opportunities where we can actually improve the NOI through operational efficiency improvements, that's what we are going to prioritize over heavy renovations. We have done multiple down to the stud renovation projects in the past, but that is something that we would be kind of staying away from in the near future. Interest rates have stabilized, but they continue to stay elevated. And I have a slide on that too. You know, although the federal funds rate have been dropped by about 1%, the interest rates continue to stay high because the 10-year treasury yields are high, and we don't see them moving. And it's not just our opinion. We follow a lot of other economists and real estate specific economists like John Chang from Marcus Millichap, Jay Parsons, Bob Fraser, Robert Kiyosaki, Ken McElroy, and almost everyone seems to have that same understanding that the rates are not going to come down tremendously. They might come down in 6 to 8 months, but they're not going to come down to the levels that we had seen around COVID. So we would probably see around 4% in 10-year treasury yields, meaning our interest rates are going to stay in high 5s to low 6s. So essentially what this means is that this signals an end of an era when it comes to flipping multifamily properties. People were buying multifamily properties and they were hitting their 5-year, 6-year pro formas in about 2 to 3 years. And they were just flipping these properties. And that was happening for 2 reasons. One, it was an incredibly hot asset class. It still is, but not as hot as it was in 2022 and 2023. So the demand for buying multifamily was incredibly high. There were a lot more new entrants entering this space and buying multifamily assets. And even the operators who were not the best at operations or renovations, they were able to do lipstick on a pig type of renovations. And at the same time, the cap rate was compressing. So your numerator, you're barely able to move that up, but your denominator is going down. So your asset value was going up pretty fast in about 2 to 3 years. And essentially in 2023, end of 2023, as the rates started to go up, the music stopped, so nobody wanted to play musical chair anymore, or a lot fewer people are still in the game. What we do see is people who are in the game are the people who have done it for long term, who have seen multiple recessions, and they realize that market cycles and the ups and downs continue to happen. And there are few fundamentals. If you focus on those few fundamentals, you can kind of ride the down cycle as well and come out okay as the markets recover. So in terms of some of the data, here's the rent growth chart up until Q2 2025, and we kind of see a clear decline of rent growth throughout the US. So this is US average, and we can see that the average rent growth all across the US in Q2 2022 was 8.2, which is really awesome, but it's abnormal. I mean, this is not a healthy rent growth number, and it's not sustainable. Usually anywhere between 2 to 3.5 is considered a more sustainable, healthy rent growth number, which is kind of what we are now seeing in the Midwestern markets. But if you look at the US average, it's currently 0.6%, which is pretty abysmal. Now, which markets are doing better than the others? You can clearly see that a lot of Midwestern markets are in the top 15, 20 markets. This is coming from CoStar. We see Cincinnati high up on the list, Pittsburgh, Kansas City, Cleveland, Detroit, Minneapolis, Indianapolis, Columbus. So a lot of Midwestern cities. But you also see San Jose, San Francisco, Chicago, because these markets did take a heavy toll during COVID as people left these markets for Sun Belt and warmer markets. But now the demand is coming back. A lot of people are actually relocating back to Silicon Valley, and now the rent growth is reflecting that. Some of the markets that are struggling are the markets that are overbuilt, and there's a lot more inventory in those markets. And also, some markets are struggling due to government policy, rent control, stuff like that. So we can see like a lot of the Sunbelt markets, Texas, Arizona, Florida markets are currently in negative rent growth. And that's primarily because when the interest rates were low in 2020, 2022, a lot of new construction started because there was a tremendous demand, and all of that inventory is now coming online, and thus resulting in heavy concessions and negative rent growth. So tying that to supply and demand, as I was alluding to, you can kind of clearly see that the blue line here is supply. And we kind of had stable supply, but it kind of went up from 2022 to now it's going to peak in, kind of mid 2025, because that's when multiple units are coming online from all the construction work that was started from 2020 through 2022. At the same time, the absorption actually fell steeply in 2023 because all the money that was handed out for free, people started to run out of that money. The economy started to show cracks. People started to move with their friends as roommates or with their family, and absorption levels were low. So oversupply with lower absorption is basically leading to a lot of the negative rent growth that we are seeing now. But we can already see that we are now about to play catch up, where absorption is steadily coming back up while the supply is going to go down if you look at the forecast. So that's a good thing. That means in about 6 to 8 months, we should start seeing more and more positive rent growth throughout the US. So I wouldn't say that today's negative rent growth should impact your decision making when it comes to pursuing deals. This is more of a temporary effect, but the rent growth probably will never return to double-digit rent growth as we saw in 2020 and 2022 in that time frame, but it will be positive rent growth at healthy levels, expected to be around 3 to 5%. And then lastly, making a commentary on the federal funds rate and 10-year treasury. Most investors, I believe, understand this, but some people who are new to, I guess, real estate investing don't quite understand that the federal funds rates are being cut or were cut, and now they're kind of holding stable. Then why did the interest rates jump? And that's mainly because the Feds can cut down the rates, but by the end of the day, your loans are based on 10-year treasury, or some banks would price it on 5-year treasury. And the treasury yield continues to stay elevated. So if you can see that we had 1% or 100 bips reduction in federal funds rate from like mid 2024 to early 2025. But if you look at the 10-year treasury yield, it has stayed relatively stable. There's a lot of volatility in the 10-year treasury yield as well, but more or less it has stayed elevated. It's at about 4.45 as of today, meaning if you try to borrow, you're probably looking at around 6.5% rate of interest with agency debt, and even higher with local banks. And that's primarily because this is backed by, essentially, these are the returns produced on 10-year treasury yields, or T-bills, treasury bonds. And the demand for US treasuries has kind of dropped. China and Japan, who are the biggest buyers, are not buying as much and have even offloaded in the past couple of years. And that's putting an upward pressure on the yield curve. But it is what it is. This is the new normal. So now we have to take all of this into consideration when we look for deals and when we underwrite deals. So essentially, what's worse than buying a bad deal? It's buying a bad deal in a bad location and at a bad time. That's the definition of catching a falling knife. You cannot control the timing, but at least you can control what kind of deal you're buying, and you can have control over location. So that's what we have decided to focus on. Focus on deal quality and focus on the location and then the asset class itself. So here's kind of the resulting change in our strategy based on some of these market shifts that we just covered. First and foremost, we are going to try our best to target only A and B class assets, and only in A and B neighborhoods. Now, the neighborhoods is way more important than the asset, because sometimes if you have an asset that needs a little bit of work, it is still fine to pursue that opportunity as long as it's in a neighborhood where you're going to get an ROI on the money you spend on fixing that asset. So looking at a relatively turnkey asset, so if the asset is a class D asset, meaning it's down to the studs, we are only buying shell of a building, that is something that we will absolutely not consider, but we would be looking at A, B, potentially C assets in only A and B neighborhoods for a long-term hold for about 7 to 10 years to capitalize on that long-term appreciation rather than those short-term profits that were stemming from really flipping properties. And that means they were actually, those profits were stemming from high-risk assets and heavy renovation component. So a lot of our deals previously were underwritten for 5-year holds. You will now see that we will be underwriting for 7 to 10-year holds for a long-term appreciation play. And of course, if we can exit sooner, if the right market cycle or market opportunities present themselves, then we would potentially exit the deal sooner, but we are underwriting for a long-term hold. A higher emphasis on value add through better operations. I kind of alluded to that as well. So not so much focus on renovations alone, but how can we actually buy the property and improve the operations? So potentially buying properties from either mom and pop sellers or unsophisticated sellers and improving the operations at that property. Now that may not necessarily be realized. Sometimes you would look at assets that are being sold by other sophisticated investors and operators. However, if the asset is in a good location and if it's a solid asset, real estate over long term always does fine, especially if it's located in a good location. So if you are able to get a good asset that cash flows at purchase, and if you're able to hold it and operate it for 7 to 10 years, you usually come out okay at the end of those 7 to 10 years. And that's really the philosophy that a lot of private equity companies and REITs and the larger like Blackstone, BlackRock, companies of that size, they usually go for institutional grade Class A assets in prime locations. Even if the numbers may look below mediocre at entry, they will hold those assets for 20 years. And in 20 years, they have appreciated significantly in value. So that's really the same thought process here.
Jay, I had a question for you. Do you
Yeah.
think other syndicators out there, in different markets, not only in Cincinnati, are doing the same thing? Do you feel like they're aligning with the same strategy?
I see many are moving to this model. We are also seeing a lot of people even transitioning to new development because they're like, okay, if the cap rates are compressed and they have expanded, but not as much, so you're still not getting a steep discount. For a lot of people, it's making sense to just build new stuff. If you're spending top dollar, might as well build new stuff. So we are seeing some shift there, but at the same time, I'm still seeing a lot of deals happening in Class C locations. You see every day on Facebook sponsored ads popping up. for deals being done in like Macon, Georgia. I saw a deal today in Macon, Georgia, and that's a tricky market. I don't know if I would be investing in Macon in a market cycle like this, right? So I would say, yeah, Andy, I think a lot of people are making those changes, but you still continue to see deals in rougher neighborhoods. And nothing wrong with that. But as an investor, you have to realize that you are taking exponentially higher risks when you are investing in those assets in those neighborhoods.
Yeah,
So,
especially, with an unknown, which is probably the highest indicator of success, and that's with an operations team that can manage an asset. So I think it's
absolutely.
one thing investors and to understand managing an asset and operations in an A class neighborhood and than a C and D class neighborhood. They're totally different animals, and you can yield
100%.
drastically different results too. So.
And honestly speaking, even good operators struggle in Class C and D locations. So, because the surprises never stop. So you're always fighting with fire
Yeah,
in some
tenant
of those.
turnover, retention and obviously, damage to the property is another aspect in your bottom line.
Mhm. Yep, absolutely. And then kind of continuing on this slide, focusing on cost basis and purchase price versus replacement cost. So I'll elaborate on this a little bit. Cost basis means exactly basically what you're paying for the property. And then comparing that with how much would it cost if I have to build this asset at this location today. So if we are paying $150,000 a door for an asset because it's in a great location, even though it might be an older asset, to build that same property today in that location, including the price of land and today's price of construction, you are potentially looking at $275,000 to $300,000. So in that comparison, you're still getting a steep discount because you're buying for that location. And of course, it has to cash flow day one, right? So instead of just looking at it needs to cash flow, for example, 10% day one, buying in a good location, even if it cash flows 3 to 5% day one, would be acceptable as long as it does cash flow. But now you're buying a property for long term in a good location. On the flip side, you might find a property in a war zone that cash flows 10% at entry, but then that cash flow is only on paper and you barely realize that cash flow because there's always something going wrong in these locations and that type of a tenant base that you have to work with. And then finally, greater focus on long-term appreciation, which I think I've hopped on this enough, and really focus more on yield on cost and equity multiple rather than cash flow alone. Because cash flows are dwindling across all asset classes as the cost of capital is going up, and the cash flow will come back and grow as the cost of capital goes down. But what we really need to focus on, we cannot control what the interest rates are, but what we can control is buying a good asset so that we can get that long-term appreciation because you're in a good location. So I think this is, again, just basically the summary of what we just said. It's mainly focus not only on higher returns, but higher risk-adjusted returns. We would rather buy a deal in a great location that looks mediocre on paper than buying a deal that looks like a home run on paper, but hinges on a million things going right. Because higher returns almost always come with higher risks. So if you understand what those risks are when you see a deal pitched to you with higher returns, that makes you a smart investor because you got to know the story. You got to understand what the deal looks like or the asset looks like, what the location is, what's the crime rate, and what are the million things that can go wrong. Unless you have a good idea of everything that can go wrong and what is the plan to address some of those things, you're not truly understanding what you're investing in. So I think this is really important, and that's going to be kind of our main focus. So here's kind of our main buy box. Our buy box has evolved over the years. So now we are looking at not only Cincinnati as a market, but also Columbus, Indianapolis, and Lexington. Northern Kentucky is essentially a part of the Cincinnati MSA. We are looking at only these markets, one, because Midwest is doing great now, and it has consistently done well. It's many times it's a steady eddy market, but we would rather pick steady eddy rather than markets where you have huge upswings and downswings, because these markets end up being a lot more predictable, and we like investing in these markets. Also because we are local to this market and we have our operations teams in these markets. So if it's a deal in Columbus, Indiana, Lexington, we all can be there on a weekly basis if we have to, because all of these markets are about an hour to hour and a half drive from where we are located in HQ in Cincinnati. Location class, as I mentioned, it's going to be A and B location class only, with median household income of at least around $75,000. Only exception being made is, okay, if we find a deal, a really good deal in a location where the household income is, let's say, 70,000, so we are close enough, but it's a location where the income is consistently going up, so we see that clear path of progress and gentrification, we would consider that asset. Asset class would be, again, A and B. Now, what we mean by asset class A and B is not necessarily based on vintage alone or age of the property, but really the condition of the asset. So even if it's an asset built in 1960s, if all the deferred maintenance is addressed, there is only minor renovation need, overall it's a well-maintained, well-managed property in a great location, then we would go after that asset. We would love to buy assets that are only 1980s or 90s or newer, but essentially in the Midwest, most of the construction boom happened from the 50s to late 70s. So most of the product and inventory we have access to is 60s and 70s product. So we have to stay open to that inventory as long as the asset has been taken care of and we don't have expensive plumbing, roofing, and other behind the wall type of expenses. Asset size, we are currently looking at 30 to 150 units. If you all are either investing passively or actively or come across a deal that could be a good fit, bring that deal to us. We are more than happy to underwrite, provide feedback, and potentially partner up on deals as well. We have done that several times in the past where people have bought us deals and we have taken it down and folks have gotten GP positions and partnerships in our deals. So we are more than happy to take a look at any of the deals that you may have. And then finally, the deal has to cash flow at purchase. So we are talking about buying good properties in good locations. More than a lot of times what we see is people buy these assets even if they have negative cash flow, just because they are good assets in good locations, they essentially overpay. But that is something that we will be staying away from. First and foremost, because we have investor capital involved. So we have to make sure that that capital is protected and then the asset is able to support itself, meaning the cash generated from the asset is able to pay for all the fixed expenses. And then there is at least some cash flow left over for emergencies. And then after 1 year or so, after we have improved the asset and improved the operation, the asset needs to cash flow even better. And that's when we can start distributions to our investors. If there are any questions, feel free to put that in the chat box. Also, you all have ability to unmute and ask questions as well. So feel free to stop us. And then I think really the last section I would like to cover is, what does all of this mean for you all as investors or potentially as co-GPs as you speak with your investors, right? So this would traditionally translate to a lower cash on cash return as compared to a rougher asset, C-class asset in C locations. But at the same time, these assets in these locations will offer a more predictable cash flow. The focus would be on long-term appreciation and equity multiples rather than higher IRRs and higher cash on cash numbers, with a hold time that is a lot longer than typical 5 years to maybe more like 7 to 10 years. Potential lower cash on cash returns, but it means, like I said, higher equity multiples. So we already covered that. And better assets in better locations, what that essentially comes down to is fewer surprises and predictable returns. And when there are a lot of surprises in the market itself, in the economy, the last thing you want to do is buy an asset that also gives you a lot of surprises and a lot of volatility. So if you want to invest in an environment that has a lot of uncertainty, then it makes sense to buy an asset that at least provides you with some certainty to kind of offset the risks that are posed by the marketplace. And finally, lower risk means better risk adjusted returns. So again, when you're comparing several deals, make sure you're comparing the overall returns, but also the risk profiles of the deal. So that's really what it boils down to. I think with that, we are constantly underwriting. Our last deal we closed was a smaller deal in March of this year. We are putting out almost 2 to 3 LOIs every week, underwriting 8 to 9 deals every week. We are doing at least about 2 to 3 property tours every week, and multiple broker meetings, lender meetings, and looking at our history, for about every 110 deals that we have underwritten, we've gotten one under contract. And now that we are shifting our strategy to be even more conservative and selective, I think that's going to probably be more like for every 200 deals that we underwrite, we might find one. But that's our goal, to focus on quality of the deal rather than just market higher returns, and then focus on long-term appreciation and protecting investor capital. Andy, if I'll pass this on to you, if you want to cover this slide and the final slide.
Sure. I just got to say, your Excel's on fire, right? You're underwriting so many deals. You you have it on your phone. Take it with you.
Yeah, every day.
Yeah. Yeah, it's amazing. I think that, when I look in a shift from when we started buying as a group back in 2020 to now, I mean, we obviously underwrote a lot of deals. It's interesting to see how the market changed. I think you did a great job covering the shift in kind of our buy box. And for those on the call that know us or don't know us, I mean, Prosper Capital has done full-on redevelopment projects in the past. Light value adds, heavy unit turns. So we've kind of seen all different levels of lifts with properties, and the market's definitely shifted. Debt makes a big difference for us, obviously, and I think the biggest thing that Jay talked about, and I'll allude to, is we're operations first group, and I think that's really the key differentiator with Prosper Capital is, myself, Jay, and DJ, we all were our own independent operators before we joined together. We each had our own portfolios that we built from, unit one or house one. I used to buy houses off of Craigslist and renovate them. So we each have underwriting experience doing renovations, leasing and managing properties. And I think that's a big difference with us. And I think any of those that are on a call that are syndicators themselves or investors, the value in understanding something simple as leasing to people is a big help. So we're not marketers. I think syndicators got a bad rap. I think I tried mentioning it earlier in the call and I got bopped off, but syndication has got a little bit of a bad rap because of all of the deals that fell through all the capital calls, especially in the southern part of the country, Jay, that you and I talked about. Kids that were raising $10-15 million and had no idea who was operating the property, anything about property management. And I think that's there's a big disparity between raising investor capital and understanding how to actually run the business. So that's what makes us different. We don't rely on one-time fees. That's another, I think, differentiator about Prosper Capital. You see a lot of syndicators out there looking to buy, refinance, and dispose because that's how they make fees, and some of them are pretty significant, Jay. Acquisition fees, I know a lot of people follow the 2-2-1 model, but what's the highest acquisition fee you've seen, Jay? I'm just curious.
5%. Seen multiple people take 5% AC fees, and and that for a lot of people, I wouldn't say everyone is doing that, but we have seen in the last 5 to 6 years, a lot of people, their whole business was acquire deals, take the AC fee, and after that, they were not really focused on operations and they were relying on those AC fees because they scaled really fast, and they were relying on these AC fees to meet payroll and to pay their people and to keep their own lights on. So
yeah,
Thankfully, we've not had that problem where our property management business sustains itself, and all three of us partners are not relying on any of these fees to put food on our table. And
Mhm.
not having that pressure is always great because now you're not in a hurry to close deals. So,
Right. And two, I think, it gives you the ability to scale methodically and strategically. And, that's kind of the other point to put here is like we're in it for the long game. And I think all those that are investors, you have to look at, who's the jockey, right? Who's the jockey running the show and what is their ultimate goal and their investment thesis. And I think all of us are very aligned that this isn't something that we're looking to do and exit overnight. And I think that's an important piece of aligning with an investment group or a sponsor. And lastly, we're conscious capitalists. We're not here just to make money and knock residents out. We're profits are important to us, investor returns are important to us, but also the well-being of everybody that's involved. The seller, us as the buyer, our residents. DJ, I think, has built a very great culture within his operations team that really cares about the residents. And we get and it shows in his Google reviews, even of the maintenance folks that go on and do the maintenance calls. So that's pretty enlightening to see. So if you want to go to the next slide, Jay. This is just a little bit about our experience as a group, and we won't spend too much time on it, but over 7 years of combined property management experience between us. We have about 550 units here under management, over 50 million in asset and transaction dollars. And Jay, 5 properties full cycle purchase to sale. I know some of those were yours.
mm,
But when you look at returns, Jay talked about this earlier in the call. Investors used to just be tunnel vision and looked at a few things on the OM. I'm guilty of it as well as a limited partner. Back in the day, you would go straight to the OM and you look at what is the cash on cash return and what is the IRR. And, what am I going to get in a pref payment if I invest in this deal? And as you mentioned, Jay, that's a really short-sighted thing to do, especially in today's market. As we shift into a more risk-adjusted return strategy. So a little bit about our results. Our average return on investment since inception for our investors is about 20%, and our average IRR is about 19, which is really strong. To me, anything that's 16 or above is a home run. So we've done no capital calls. There's a lot of the guys down south in the great state of Texas that we've heard that have fell into, unfortunately, losing capital, and several that have done capital calls. So Jay, I know you and I talked a little bit about that yesterday, which is
mm.
unfortunate to see, but you saw some reckless syndicating and some reckless sponsors out there not doing the best for their investors. So
Yeah. I mean, some of it was unfortunate because of changing market conditions, but a lot of it was avoidable. I mean,
yeah,
it was greed that was driving a lot of it.
yeah.
But I think that's all we had for you folks. Any questions that come up, these are our contacts. We have our Calendly links over here as well. We would love to do one-on-one calls as well. If we haven't connected already, always good to catch up. But if there are any questions, please feel free to unmute, put them in the chat box. Any other closing comments from you, Andy?
I just, really appreciate everybody's time being on here. And Jay, thanks for putting this together. It's been great to see Prosper grow over the last 5 years, and it'd be great to see where we are in 5 more. So just thanks to everybody that's partnered with us, those that haven't. We love the opportunity to have a call with you, as Jay said. So definitely reach out.
Great. Awesome. Well, thank you
Great.
all again for joining us this evening, and have a wonderful evening. We are more than happy to take questions after as well. And like we said, it's always good to catch up. So would love to jump on a one-on-one Zoom call with you all. A lot of you who are on the call, half of you have already dropped off, but we have already had one-on-one conversations. But as operators, it's always great for us to stay connected, with our investors and understand what you all are looking for, what you all are seeing in the marketplace, so that we can kind of continue to feel the pulse in terms of the investor community as well. So again, thank you all so much and have a wonderful evening.
Thanks, everyone.